Hey everyone! I'm just one person, hidden deep in the countryside, surrounded by silence. But I built BlockSonic to speak with the entire world. Here, you don't get noise, you get the pulse of Bitcoin, every single day distilled into pure, essential updates. No teams, no sponsors, no filters. Just me, a signal from the quietest place on Earth, bringing you the most important Bitcoin news before the world wakes up. With BlockSonic, you don't need to search for information. I research, I write, and I tell the story behind every headline. I do the digging. I chase the truth. All you have to do is listen. Today, our news, you think the bottom is in, but is one more dip due, is really a question about human patience under uncertainty. You want the comfort of a clean floor, yet markets rarely grant comfort on schedule. We'll walk through why one careful observer thinks Bitcoin could still revisit the $40,000 before any durable recovery, and why that possibility isn't a prophecy, but a reading of incentives, leverage, and thin liquidity. We'll look at the strange calm of Bitcoin holding steady in extreme fear, even as jobs data arrives louder than the reality beneath it. We'll track Binance reshaping its safety reserve into Bitcoin, and what it signals when paper claims return to par and appetite quietly reawakens. And we'll end with a practical shift. Stop hunting the exact bottom and start learning what the next dip is trying to tell you. Forget $80,000. Why one observer thinks Bitcoin may still revisit the 40,000 range before recovery. You and I keep watching people search for a bottom as if it were a single number you can point to with confidence. But when we follow the logic of past cycles and the incentives around scarcity, we see a calmer possibility. The market may still demand one more lesson in pain before it offers a steadier foundation. You feel the tension, do you not? Everyone wants the comfort of a quick bottom, yet markets rarely grant comfort on schedule. Let us begin with what is simplest. People act with purpose, and they act under uncertainty. In a fragile environment, optimism is not a forecast, it is a preference. And preferences do not move prices unless they are backed by real buying power and real patience. This is why Michael Terpin, the Chief Executive Officer of Transform Ventures, looks at the current crypto market and says it is unfolding almost exactly as historical patterns would suggest. Not because history is a machine, but because human responses to profit, fear, and regret tend to rhyme when the same incentives return. Then you hear someone declare that the bottom had to be at $80,000 and that the bear market would last only 6 weeks. Notice what is being smuggled in. It is not analysis. It is a desire to skip the part where speculation unwinds and weak conviction is forced to sell. Terpin calls that kind of confidence ridiculous, and we can see why without raising our voice. A market that rose on crowded expectations does not usually reset with a gentle dip and a tidy calendar. And when others proposed $60,000 as the floor, followed by an immediate climb, he heard the same impatience wearing a different outfit. Too soon, he said, because the market had not yet finished asking the hard question: who is holding Bitcoin because they understand it, and who is holding because they wanted a fast exit into someone else's enthusiasm? Now here's the midpoint where you should pause with me. If everyone can see the cycle, why does it still hurt? Because seeing a pattern is not the same as living through it. The knowledge is dispersed, the time horizons differ, and each person must decide whether to bear uncertainty or hand it to someone else at a discount. Terpin does not insist on another year-long drawdown. He simply suggests something more modest and therefore more plausible, one more point of pain. In his view, Bitcoin could revisit the 50,000 range or even the 40,000 range before a more durable bottom is formed. To understand why that claim is not mere pessimism, we need to look at the mechanism people keep treating as a magic spell: the halving. The halving matters because it reduces the reward miners receive for validating transactions by half, roughly every 4 years. That is not a slogan. It is a rule that changes the flow of new supply. This built-in supply shock is central to Bitcoin's scarcity. And scarcity is not poetry. It is a constraint. When new supply slows while demand holds steady or rises, the price pressure can turn upward. That is why halvings have often preceded major bull markets. Over time, this mechanism slows Bitcoin's inflation rate and ultimately caps total supply at 21 million coins. That cap reinforces the idea of Bitcoin as digital gold, not because someone declared it, but because the supply schedule is not negotiable. Yet notice the paradox. The same predictable scarcity that attracts long-term savers also invites short-term speculators to front-run the story. And when too many people try to harvest tomorrow's price today, the market often punishes them before it rewards the patient. Terpin says, "We are exactly where we should be," and he anchors that statement in the well-established 4-year cycle around the halving. He points to one of the more reliable elements of prior cycles, the rough timing of the bubble peak and the subsequent unwind. He argues that the bull market tends to pop in the fourth quarter after the halving, and that the speculative blow-off phase typically lasts between 9 and 11 months. This time, he says, it was 11 months. Then he draws a close parallel to the last cycle, giving you a date pair that feels almost too neat to be real. The highs, the bubble popping, were on November 10th, 2021. The lows were right after FTX declared bankruptcy on November 10th, 2022, exactly a year to the day. Even the broader rhythm shows consistency in his telling. One full cycle was off by only 3 days from a clean 4-year interval, while the first halving cycle was only a few weeks off a year in its peak-to-trough structure. Now let us be careful, you and I. This is not a guarantee that the next move must match the last move. It is something subtler, a reminder that markets are social processes, and social processes often repeat when the same hopes and the same leverage return. So if Bitcoin revisits the 40,000 range, it would not be a betrayal of the halving story. It could be the market completing its resorting, transferring coins from those who needed a narrative to those who can tolerate time. And if it does not revisit those levels, the deeper lesson remains the same. The bottom is not a number. The bottom is the moment when forced sellers are mostly gone, and when remaining holders are aligned with what they claim to believe. Let us end quietly here. When you stop asking, what price must happen next, and start asking, what kinds of people must be holding for stability to emerge, the cycle becomes less mysterious. If you have your own way of reading these cycles, leave it beside ours and let us compare the logic rather than the slogans. Crypto buyers stare at extreme fear and still lift Bitcoin. Your day ahead for February 12th, 2026, seen through the logic of action, expectation, and the quiet struggle between fear and conviction. You and I can watch a curious paradox unfold. The crowd reports extreme fear, yet the price rises anyway. Begin with the simplest unit of reality here. Not charts, but human choice. People buy or sell because they expect a future that feels more valuable than the present alternative. And they act under scarcity, uncertainty, and time. Over the last 24 hours, Bitcoin traded around $66,988.52, and the wider crypto market rose with it, even as a fresh employment report signaled something awkward. Many sectors looked restrained, yet the headline count exceeded forecasts, and with that came a dampening of near-term hopes for lower interest rates. Notice what this means for the mind of the trader. When cuts to interest rates feel less likely, the relative appeal of fixed income yield stays higher for longer, and the easy story says riskier assets should lose their shine. Yet the market did not obey the easy story, because markets do not move on slogans. They move on marginal decisions made by individuals who revise expectations at the edge. Bitcoin rose about 1.25% in that window, and a broad index of large crypto assets added roughly 1.18%. This resilience matters because it comes right after a bruising decline that pushed Bitcoin down near $60,000, a level that recently felt like a floor until it did not. Here is the conflict that teaches the most. That sell-off crystallized losses rather than merely threatening them, with realized losses estimated around $3.2 billion, described as the largest such wave in Bitcoin's history, even surpassing the turmoil around Terra in 2022. Another analytics group called the episode a textbook capitulation, meaning the holders with the weakest conviction rushed to convert uncertainty into finality. And you can see the same story in the structure of bets. Open interest fell sharply, which is another way of saying many leveraged positions were closed or forced closed, reducing the market's immediate fragility while also draining it of eager risk takers. Now we reach the quiet revelation. After a purge, the remaining holders are often the ones least willing to sell, not because they are saints, but because their subjective valuations differ. They either have longer time horizons, lower urgency for liquidity, or a stronger belief that the future purchasing power of the asset will exceed what they can gain by selling today. So even as interest rate cuts appear more distant, selling pressure can fade. Price does not need universal optimism to rise. It only needs the next seller to hesitate, and the next buyer to accept the offered terms. You can watch expectations quantify themselves in probability markets. The implied chance of a rate cut of about 25 basis points next month fell to around 7%, down from the high teens previously cited on one venue and down from around 20% on another. Each percentage point here is not a fact about the world, but a price on belief, updated as new information arrives. Bitcoin's positive reaction under these conditions suggests something plain and easily missed. Sellers may be running out of urgency. When fear is high, yet liquidation is exhausted, the market can rise not on euphoria, but on the simple absence of further forced selling. Add one more signal to the picture. A fear and greed gauge fell to its lowest level since the collapse of ETX in 2022. That does not predict the future, but it tells you about the present emotional climate in which choices are being made. And sometimes the bottom is not a triumphant moment. Sometimes it is merely the point where the marginal seller disappears. Still, we should not pretend uncertainty has been abolished. The next consumer price inflation report will matter because it feeds expectations about future monetary conditions, and those expectations ripple through discount rates, opportunity costs, and the willingness to hold risk. So we end in a calm place. You are watching a market attempt to re-coordinate after pain, where fear can coexist with rising prices because action is never collective in a single direction. It is always individual, always marginal, always revised. If you find yourself pausing at that paradox, you are already closer to the real signal beneath the noise, and it may be worth keeping your own notes on what changed in you when the market refused to behave the way the crowd expected. If you believe in what we're doing and want to support BlockSonic's growth, just scan the QR code on the screen or copy the link in the description. Every contribution makes a difference and helps us keep delivering quality, independent, and up-to-date content for you. Bitcoin holds steady in extreme fear as a hot jobs report reveals a quieter reality. You are watching a strange tension unfold. Fear sits at an extreme, yet Bitcoin refuses to flinch, even when new employment data should have jolted the market into retreat. If we slow down and follow the logic of action, we will see why a strong headline can still conceal cooling beneath it, why expectations about interest rates matter only through human choices. and why a market that stops selling may be telling you more than any index ever could. How do we explain a market that is supposed to fear higher rates, yet calmly absorbs a surprisingly strong jobs report? We begin with what you can observe. Bitcoin is hovering near $67,800, up on the day after trading around $66,988.52. As the broader crypto market digests January's stronger than expected employment report without an immediate rush to sell. That absence of panic is not nothing. In markets, action is information, and inaction can be even louder. When bad news arrives and sellers do not press harder, we are forced to consider a simple possibility. Many who wanted to sell have already done so. Now watch how sentiment shifts without any official announcement. A muted reaction can signal seller exhaustion and a growing willingness to hold risk, even when the backdrop still feels harsh. The CoinDesk 20 index has gained 1.5% since midnight coordinated universal time, with all but one token advancing, a small but coherent sign that the urge to flee is not dominating the moment. Here's where the employment report enters, and you must treat it as a clue, not a verdict. The economy added 130,000 jobs in January, nearly double the expected 70,000. That headline immediately reshapes expectations about future interest rates, because people act on what they believe the cost of money will be. And when expectations shift, portfolios shift. The stronger than expected number reduced the odds of an early interest rate cut, pushing expectations outward toward July. Normally, that would weigh on assets people treat as risk, including cryptocurrencies, because a higher expected return on safer alternatives changes the trade-offs in the mind of the marginal buyer. But the same report contains a quiet contradiction. Job growth remained concentrated in healthcare-related sectors, while other areas were mostly little changed. So the heat is real in one place, yet the breadth is missing. The headline looks red hot, while the underlying pattern suggests cooling across the wider economy. This is the midpoint where many viewers get lost, so we slow down. A single number can excite the crowd, but markets are not crowds reacting to a number. Markets are countless individuals, each with their own constraints, each trying to anticipate what others will do next. If the report hints at cooling beneath the surface, then the path of future conditions becomes less certain, and uncertainty changes behavior in ways the headline cannot capture. So Bitcoin's resilience begins to look less like defiance and more like coordination. If sellers are exhausted, the market can rise not because everyone feels optimistic, but because fewer people remain willing to sell at current prices. Now consider the final piece of the puzzle. Sentiment is still low. The crypto fear and greed index sits at 5, its lowest level since the collapse of FTX in 2022. Extreme fear means many minds are already positioned defensively. When that is true, it takes less new buying to move price, because the supply offered at the margin has thinned. So what are we really seeing? Not a victory over fear, and not a clean confirmation of strength, but a subtle shift in the balance of urgency. The headline says heat, the details say narrowness, and the price says the market has already paid for much of the worry. If you sit with that for a moment, you may notice the deeper lesson. Markets do not move on facts, they move on how people have already acted in anticipation of those facts. And sometimes the most revealing signal is not the drama you expected, but the calm that arrives when the selling simply runs out. If this helped you see the report and the price as one chain of human choices rather than isolated events, you may want to leave your own reading of what the market is quietly admitting right now. Binance turns its $1 billion safety reserve into 15,000 Bitcoin. You and I are watching a safety net change its shape without changing its purpose. A fund meant to protect users is being rebuilt around a single idea. That Bitcoin, not promises of steadiness, will be the reserve they trust over time. You might think a safety fund should avoid volatility, yet here we see the opposite choice. We will walk through what was done, why it was done, and what this reveals about how institutions learn to hold value when the future refuses to sit. If a safety net is meant to reduce uncertainty, why would anyone weave it from an asset that moves? Because the purpose of a reserve is not to look calm in the present. The purpose is to be there when you need it. And that forces a harder question. What asset is most likely to remain saleable, transferable, and credible when conditions change? Binance has now completed the final step of converting its secure asset fund for users, often called SAFU, entirely into Bitcoin. In plain terms, they finished a transition of about $1 billion out of stablecoin reserves and into Bitcoin, closing the plan they set in motion over a 30-day window. The last purchase was a final tranche of 4,005. That brought the fund to 15,000 Bitcoin in total, valued at roughly $1.005 billion, at a Bitcoin price near $67,000 at the moment they marked completion, shared publicly on a Thursday. And while you and I read those numbers, the market does what markets do. Bitcoin traded around $67,500 near publication, reminding us that the unit of account here is not fixed, even if the intention. Now let us slow down and look at the fund itself. SAFU was created to protect users from losses caused by unforeseen events, such as hacks. It was originally backed by a mix of assets, including stablecoins, which are designed to track a dollar value. Under the new framework, the fund is fully denominated in Bitcoin. Here's the quiet tension. A stablecoin aims at stability of price, while a reserve aims at stability of function. When you choose a reserve asset, you are choosing what you believe will remain liquid and dependable under stress, not what will merely print the smoothest chart. Binance also stated a rule that matters for incentives. If the value of this Bitcoin-denominated reserve falls below $800 million due to market volatility, they pledged to replenish it. That is not a prediction about price. It is a commitment about behavior, and commitments are what make a safety mechanism more than a slogan. The timeline also tells us something about institutional action. The 30-day transition finished within the window Binance set when it first announced the shift. The move traces back to late January, when they revealed they would convert $1 billion in dollar-pegged tokens held in SAFU into Bitcoin, explicitly reinforcing their view of Bitcoin as a long-term reserve asset. Pause with me on that phrase, long-term reserve. It is not a technical label. It is a statement about time preference. It says, in effect, we would rather accept short-run fluctuation than hold an instrument whose steadiness depends on counterparties, conventions, and continuing confidence in an external peg. And Binance is not alone in this pattern. A growing number of firms have begun adopting Bitcoin as a strategic reserve asset in recent years, shifting portions of their treasuries away from conventional currency holdings and into Bitcoin. You can interpret this as fashion, but reason suggests a deeper cause. When yields are low and monetary units are persistently diluted, actors search for a store of value that does not require permission to move and does not depend on a single issuer to remain scarce. The process also had an observable starting signal on-chain. On February 2nd, Binance moved 1,1315 Bitcoin, worth roughly $100 million at the time, from its hot wallets into SAFU. That transfer was not the whole story, but it marked the beginning of what became one of the largest single treasury-style reallocations into Bitcoin by a crypto exchange. And so we return to the core claim. Binance says a fully Bitcoin-backed SAFU underscores its confidence in Bitcoin as the premier long-term reserve asset. Whether you agree is not the first question. The first question is what their action reveals. When uncertainty cannot be abolished, people stop buying the appearance of certainty and start buying resilience. Sit with that for a moment. A safety net is not made strong by pretending risk is gone. It is made strong by choosing what you believe will still function when risk arrives. If you have seen a reserve differently after this, hold on to that thought and tell me what part of the logic felt most inevitable once it was named. And don't forget to subscribe to the channel, like, share with your friends, and participate in the chat. These simple actions really help the project grow and keep BlockSonic running at full speed every day. When a paper claim returns to par, a Bitcoin appetite can reawaken. You are watching a quiet mechanism of coordination at work. A security drifts back to its promised reference point, and suddenly a path reopens for fresh Bitcoin accumulation, even while the underlying asset feels uncertain. We begin with a small paradox, and you can feel it immediately. Bitcoin weakens, yet the instrument designed around it regains strength. Stretch, known as Sierra Tango Romeo Charlie, is the perpetual preferred equity issued by Strategy, known as Mike Sierra Tango Romeo, a firm widely recognized for holding more Bitcoin than any other corporation. During the United States session on Wednesday, this preferred share climbed back to its par value of $100 for the first time since mid-January. Now we ask the practical question that always matters in markets. Why does $100 matter so much? Because trading at or above par is not merely a psychological milestone. It is a functional threshold that can enable Strategy to resume at the market offerings, a method used to raise funds in real time. And those funds can be directed toward additional Bitcoin acquisitions. Notice how the timeline reveals the tension between asset prices and funding conditions. The last time Sierra Tango Romeo Charlie touched $100 was January 16th, when Bitcoin hovered near $97,000. Then Bitcoin retreated, reaching as low as $60,000 by February 5th, and the preferred share slipped as well, falling to a low near $93 before rebounding to its recent level. Here is the deeper logic. A firm that wants more Bitcoin does not merely need conviction. It needs financing that can be executed without punishing itself in the process. When the preferred share trades below par, raising new capital through that channel becomes harder because the market is signaling a higher cost or a higher skepticism. When it returns to par, the channel clears, and action becomes feasible again. We should also look closely at what Sierra Tango Romeo Charlie is meant to be in the eyes of the buyer. It is positioned as a short-duration, high-yield credit-like instrument, and it currently offers an 11.25% annual dividend, distributed monthly. That yield is not a decoration. It is a price offered to the saver to persuade them to part with present goods in exchange for a stream of future goods. And because human valuations shift with uncertainty, Strategy resets this dividend rate monthly. The purpose is straightforward: reduce volatility around par and give traders a reason to keep the security anchored near $100. Recently, the rate was raised to the current 11.25% yield, an adjustment that tells you something simple and enduring. When confidence wavers, terms must improve. Midway through this, you might notice another quiet contradiction. The preferred instrument stabilizes, yet the common equity absorbs pressure. Strategy's common stock fell 5% on Wednesday, closing at $126, while Bitcoin hovered around $67,500. So what are you really seeing? Not a story about tickers, but a story about coordination under uncertainty. Different claims on the same enterprise can carry different roles, different buyers, and different tolerances for risk. The preferred share is being tuned to stay near its reference point, because that stability can reopen a funding path. The common share, exposed to broader expectations, can drift as those expectations change. If you sit with it for a moment, the outline becomes clear. Prices are not verdicts handed down from above. They are signals formed from countless individual choices, each one an attempt to trade uncertainty for a preferred future. And if you have your own way of explaining why par value can matter more than headlines, leave that thought with us here, so we can examine it together. Last week's rout etched Bitcoin's largest realized loss, yet the first bottoming signals appear. The shock on February 5th did not merely move price, it forced holders to admit error in public, booking the largest realized loss in Bitcoin's history, about $3.2 billion. If we follow that admission carefully, you will see why extreme pain sometimes carries the first hints of a turning point. You and I can start with a paradox. The market can look most hopeless at the very moment it becomes more honest. Last week's downturn delivered the largest realized loss ever recorded in Bitcoin, as price fell from about $70,000 to about $60,000 on February 5th. This was not just a decline on a screen. It was a wave of human action where plans were abandoned, time preferences changed, and fear became a motive strong enough to override patience. Glassnode captures this through a measure called entity, adjusted realized loss, which reached about $3.2 billion. The logic of the metric is simple. It counts the dollar value of coins that moved and were sold for less than their acquisition price, while filtering out transfers that are merely internal reshuffling within the same controlling entity. In other words, it tries to isolate genuine surrender from accounting noise. Now notice what a realized loss truly is. An unrealized loss is a thought, a private discomfort, a hope that time will heal. A realized loss is a decision. It is the moment someone says to themselves and to the market that the old plan is no longer worth carrying. This is why the event shattered prior records. It surpassed even the bleak stretches of 2022, exceeding the roughly $2.7 billion recorded during the lunar collapse, when the price was around $0.06090. The comparison matters because it tells us the scale of coordinated disappointment, not because one episode is morally worse than another, but because each episode reveals how quickly conviction can evaporate when uncertainty becomes personal. Check on Chain describes last week's sell-off as meeting the criteria of a textbook capitulation event: rapid movement, heavy volume, and losses crystallized by the lowest conviction holders. Let us translate that into plain human terms. The first to sell in panic are often those who never truly integrated the risk into their plans. They borrowed confidence from a rising chart, and when the chart withdrew its gift, they paid for it in haste. Here is the mid-course question we should sit with. If the least committed holders have already paid the price of their weak commitment, who remains on the other side of the trade? Daily net losses exceeded about $1/5 billion, making this the most significant absolute dollar loss ever crystallized in the network's history. Such a figure is not just a statistic. It is dispersed knowledge becoming visible as countless individuals independently decide that the present pain outweighs the future possibility. And yet, precisely because capitulation is an act of clearing, it can also be the first condition for stabilization. When sellers who cannot endure uncertainty finally exit, the market's remaining holders are, by revealed preference, more willing to bear risk. That does not guarantee a bottom. It simply explains why bottoming signals often emerge only after the market has forced a harsh reconciliation between belief and reality. As we speak, Bitcoin trades around $67,600. Price is the surface. The deeper story is that last week, many people stopped pretending, and that honesty, however costly, is what allows a new coordination to form. If you want to respond, do not tell us what you hope happens next. Tell us what last week's capitulation revealed to you about conviction, risk, and the plans people make when the future stops feeling smooth. And don't forget to subscribe to the channel, like, share with your friends, and participate in the chat. These simple actions really help the project grow and keep BlockSonic running at full speed every day. Stop hunting the exact bottom and start looking for the dip. You and I keep returning to the same temptation. To believe the perfect moment exists, waiting to be captured. Thomas Lee, speaking at Consensus Hong Kong in 2026, argues we should trade that temptation for something more human and more workable. The search for opportunity inside a downturn that feels like a small winter. If you listen closely, the message is not a slogan about optimism. It is a claim about action under uncertainty. When prices fall, the mind wants certainty most, and that is precisely when certainty is least available. So we will walk through what Lee said, what the price moves reveal, and what his own forecasting record quietly teaches about the limits of prediction. You feel it, don't you, this paradox? The moment you most want a guaranteed bottom is the moment the market is least able to grant you one. Lee stood on stage in Hong Kong and told investors to stop obsessing over the exact low and start looking for entries. Notice what he is really doing here? He is not promising you a floor. He is reminding you that action must proceed, even when knowledge is incomplete. Because waiting for perfect clarity is itself a choice with a cost. He put it plainly. You should be thinking about opportunities here instead of selling. And we can deduce why that line lands. When fear rises, the urge is to convert uncertainty into the illusion of safety. Yet the market is not a machine that rewards comfort. It is a process that rewards correct anticipation of others' future valuations, and that is never delivered with certainty. Now look at the recent path of Bitcoin. It suffered a 50% drawdown from its October record highs, described as its worst correction since 2022. A drawdown of that size is not merely a statistic. It is a test of time preference. It asks you whether you are acting as an owner with patience or as a speculator demanding immediate emotional relief. Midweek, Bitcoin slipped back below $67,000, surrendering part of its rebound from the prior week's crash lows. Over the weekend, it had reversed sharply, moving above $72,000 from $60,000. And then in the following day, it was down 2.8% over the past 24 hours. Ethereum also fell, sliding to about $1950, roughly 3% lower. You can feel the whiplash in those numbers, but the deeper point is this. Volatility is the visible trace of disagreement. It is not a glitch. It is the market showing you, in real time, that minds do not share one forecast. Here's the midstream question we should ask ourselves. When prices swing this violently, are we witnessing new information? Or are we witnessing forced selling that has little to do with long-term value? Lee attributed the weakness in crypto prices to volatility in metals that rippled across asset classes. He pointed to gold's market capitalization, fluctuating by trillions of dollars in a single day in late January, triggering margin calls and weighing on risk assets. This is an important chain of causation. When leverage exists, price moves do not stay confined to the asset that moved first. They spread through balance sheets. They become liquidations, not judgments. And liquidations are rarely philosophical. Then Lee makes a comparative claim. After Bitcoin severely underperformed gold in 2025, he thinks gold has likely topped for this year, and Bitcoin is poised to outperform through 2026. Whether that forecast proves right is less important than the structure of the argument. Relative performance shapes narratives, narratives shape positioning, and positioning shapes the next wave of flows. Markets are not only about fundamentals. They are also about who is crowded, who is under-owned, and who is forced to act. He also spoke about Ethereum's history. Repeated 50% drawdowns since 2018 have often been followed by sharp rebounds. There is a seduction here we must handle carefully. Patterns can inform, but they can also anesthetize. The fact that something happened before does not compel it to happen again. It merely tells you that participants have tolerated similar pain and later repriced their expectations. To sharpen the point, Lee cited technician Tom DeMark and suggested Ethereum may need to briefly dip below $1,800 to form what DeMark calls a perfected bottom before a more sustained recovery. Do you see the tension? We began by rejecting the obsession with exact bottoms, and yet here we are describing a specific level that would complete the bottom. This is not hypocrisy so much as it is the mind's constant struggle. We want rules precise enough to soothe us, in a world too complex to be tamed by precision. And now we arrive at the quiet constraint that hangs over every confident forecast, the forecaster's own fallibility. Lee's recent record offers a sober reminder. In August 2025, he predicted Bitcoin would reach $200,000 by the end of that year. Bitcoin instead peaked at $126,000 in October, then retreated to $88,500 by December 31st. Later, he said Bitcoin could reach another all-time high in January 2026, but by January 31st, it had fallen to $78,500. The lesson is not that Lee is uniquely wrong. The lesson is that the future is not a datum waiting to be read. It is an outcome formed by countless independent plans, revised under pressure, colliding and coordinating through prices. So what should you take from all this if you want something sturdier than prediction? First, if you wait for the market to certify the bottom, you are asking for a guarantee that cannot exist. The bottom is only obvious after it is gone, because certainty is purchased with hindsight. Second, when cross-market shocks trigger margin calls, price can fall for reasons unrelated to long-run adoption or usefulness. That does not make buying automatically wise, but it does mean selling in panic may be less risk management than it is participation in a forced unwind. Third, patterns like repeated drawdowns and rebounds can be clues, not commandments. They can help you frame possibilities, but they cannot absolve you of judgment. And finally, forecasts should be treated as inputs, not anchors. Even skilled observers are bound by dispersed knowledge and shifting conditions. If you hand your conviction to someone else's number, you outsource the very responsibility that investing demands. Let's pause here together. The truth is almost simple. You cannot time what cannot be known, but you can decide how you will act when uncertainty is the price of admission. If you have ever felt that tension between waiting for perfect clarity and stepping forward with imperfect knowledge, it may be worth holding on to this question for later. What would your choices look like if you stopped trying to defeat uncertainty and started pricing it in? Beasts, Swagger, and the quiet birth of a new financial gatekeeper. You and I are used to thinking that finance is built in marble towers, then distributed outward. But what if the next great financial institution is built inside attention itself, where trust is earned daily and habits are formed before wealth even arrives? Let us trace the logic behind when investors claim that a popular creator's move into banking could become a generational doorway into digital assets. You and I begin with a paradox. The place where young people learn to spend, save, and trust is often not a bank at all, but a screen in their pocket. When a person acts, you know they choose means to reach ends. And in modern life, attention is not decoration around action. It is the first scarce resource being allocated. Whoever coordinates attention often gains the first chance to coordinate everything that follows: habits, preferences, and eventually financial decisions. Now consider the claim made by Thomas Lee, chairman of an Ethereum treasury firm called Bitmine Immersion. He suggests that the next major financial institution, For the rising generation may not emerge from the traditional centers of finance, but from a video creator with an audience that already lives inside his orbit. You can see the reasoning. A young person does not begin with portfolios. They begin with identity, community, and repeated experience. If a platform becomes the place where you feel understood, where you learn what is normal, where you return without effort, then it quietly becomes a default setting for future choices. Lee points to a specific move. The company associated with Mr. Beast agreed earlier this month to acquire a neobank called Step. Bitmine invested $200 million in Mr. Beast's company, and Lee frames this as a long-term wager on how younger generations will access financial services. Pause with me here, because the conflict is subtle. Many people assume finance is adopted when someone becomes wealthy. But wealth does not create the channel. The channel is built first, and wealth later flows through what already feels natural. Lee puts it plainly. Mr. Beast has a chance to become the financial institution of his generation. Not because he has the oldest brand, but because he may have the most intimate distribution of trust. Then he reaches for historical parallels, and you can test them against your own understanding. Charles Schwab became a defining portal for baby boomers. BlackRock and Blackstone became magnets for the capital of Generation X. Robinhood captured the imagination and activity of many millennials. In each case, a new cohort did not merely choose a product, they adopted a default pathway into markets. Here is the midpoint hook we should not miss. The decisive competition in finance is often not about who has the best instrument, but about who becomes the first interface. Lee notes that Generation Z and Generation Alpha together represent about 120 million people in the United States alone. And he observes that Mr. Beast has built an audience of more than 1 billion followers globally. Those are not just numbers. They are a map of potential coordination, a way to reduce the friction between curiosity and action. Yet another contradiction appears. Lee admits these customers are not necessarily wealthy today, and that is precisely why the opportunity matters. The most durable financial relationships are often formed before wealth arrives, when routines are still being written and loyalties are still fluid. He adds the temporal element. Over the next decade, these young people will participate in a major wealth transfer. If Step becomes their primary financial platform, the platform does not merely serve them, it shapes what they consider normal to hold, normal to trade, normal to save. And now we arrive at the deeper implication. If that primary platform treats digital assets as native rather than exotic, then digital assets stop being a special topic and become part of ordinary financial life. From there, Lee's conclusion follows without drama. If Step becomes the default gateway, then Bitmain's investment in Mr. Beast's company could place it near the center of a generation whose financial instincts are already digital. Not because anyone commands them, but because the path of least resistance is often the path most people take. So you and I end with a quiet recognition. The future is not always won by the institution with the most history. It is often won by the institution that becomes the first habit. If you have ever wondered why certain platforms seem to become inevitable, hold this thought and tell me what you think. Is the real battle in finance about products or about where trust is formed before money even shows up? And don't forget to subscribe to the channel, like, share with your friends, and participate in the chat. These simple actions really help the project grow and keep BlockSonic running at full speed every day. Metaplanet keeps buying Bitcoin while its own price falls, and that is the point. Metaplanet is the largest publicly traded Bitcoin holder in Asia, yet it sits far below its average purchase price per Bitcoin, around $107,000. We are going to look at what that choice really means when the market refuses to agree with you. You and I both know the first paradox. A firm says it is building for the future, while the present punishes it. We begin with human action. A leader chooses a plan, not because the plan is comfortable, but because he believes it coordinates scarce means toward a preferred end. Simon Garovich, the chief executive officer of Metaplanet, tells you plainly that the firm will keep accumulating Bitcoin, expand revenue, and prepare for a next phase of growth, even as the share price declines. Now we touch the conflict that every saver recognizes. The market does not reward conviction on schedule. Bitcoin, the asset Metaplanet is accumulating, fell sharply from its prior peak, losing more than 47% since touching a record high in October, and dropping 14% in a single Thursday. When the price falls, the crowd learns fear faster than it learns structure. Here's the midstream hook you should not ignore. If the plan were only to look successful today, the buying would stop precisely when the price turns against them. Yet the stated intention is the opposite, to buy steadily through the decline. That tells you the firm is treating volatility not as a verdict, but as a condition. But markets translate conditions into consequences. Metaplanet's own stock moved with the same gravity, ending the week around 340 yen, or about $2.16, after falling roughly 82% from a high near 1930 yen in June. And after the latest Bitcoin slump, the shares fell another 5.6%. You can feel the pressure here. The firm's chosen instrument is falling, and the firm itself is repriced downward as the public revises its expectations. So we ask a calmer question. What is the plan in concrete terms, not in slogans? Metaplanet calls it the 555 million plan, aiming to reach 100,000 Bitcoin by the end of 2026 and 210,000 Bitcoin by 2027. Its holdings rose from 1762 Bitcoin at the end of 2024 to 35,102 Bitcoin now, valued around $2.5 billion at current prices. Now comes the quiet but decisive arithmetic of error and time. The average acquisition cost is about $107,000 per Bitcoin, while the current price is around $66,270. That gap is not merely an accounting wound. It is a visible statement that past expectations did not match present valuations, and that the firm is choosing to endure the mismatch rather than liquidate it. And endurance is never free. The firm carries roughly $280 million in outstanding debt. Debt is a promise made under uncertainty, and when the underlying asset falls, the promise does not shrink with it. You can already see the tension between two clocks. The market's clock, which reprices instantly, and the firm's clock, which must survive long enough for its thesis to be tested. If you widen your view, you notice another layer of coordination. Metaplanet ranks as the fourth largest publicly traded holder of Bitcoin globally. Ahead of it are Strategy Incorporated with 713,502 Bitcoin, Mara Holdings with 53,250 Bitcoin, and 21 Capital with 43,514 Bitcoin. This is not merely a leaderboard. It is a map of who is willing to convert corporate balance sheets into a wager on a monetary asset. Here is the second hook, more subtle than the first. When multiple firms adopt the same treasury posture, the question stops being, who is brave, and becomes, what problem are they trying to solve with this instrument? In other words, what are they escaping from, and what are they trying to hold still? Metaplanet's next move reveals the means chosen to pursue the end. On January 29th, it announced plans to raise up to 21 billion yen to fund additional Bitcoin purchases and pay down debt. The mechanism is dilution and optionality. The sale of 24.53 million new common shares at $499 each, along with stock warrants aimed at select investors. And now we can state the full structure without drama. The firm is exchanging a claim on itself, new shares, for funds to acquire more of the asset it believes will matter most later, while also attempting to reduce the fragility created by debt. Shareholders who remain are not merely betting on Bitcoin. They are betting on management's ability to finance time. So we end where reason always ends, with the recognition that prices are not moral judgments, they are signals. Metanet is choosing to treat a falling price as an invitation to accumulate, while the market treats that same fall as a reason to discount the firm. Both can be rational, because both are expressions of different time preferences and different tolerances for uncertainty. If you sit with that for a moment, you may notice the real question beneath the headlines. When you watch a plan persist through pain, are you seeing stubbornness? Or are you seeing a deliberate purchase of tomorrow at today's unpopular price? If you have your own answer, leave it where others can find it, and we will compare our deductions in the open air of reason. Weak earnings weigh on Iron and Amazon as Bitcoin-linked shares rediscover their footing. You can watch two stories unfold at once. When expectations fall faster than results, prices punish even honest effort. Yet when fear loosens its grip, the same market can reprice an entire corner of risk in a single breath. We will trace how earnings, capital spending, and Bitcoin's rebound each transmit information, and why the contradictions only seem confusing until you follow the logic of action. You and I begin with a simple fact. A firm can work hard, build, finance, and still disappoint because the market is not paying for effort. It is paying for alignment between what you expected and what reality delivered at the margin today. Look at Iron first. You see a business accelerating its transition from Bitcoin mining toward artificial intelligence cloud services, and you might assume the narrative alone should carry the price. But the market asks a colder question. Did the reported numbers confirm the story quickly enough to justify the valuation you were already willing to pay? The earnings did not. Headline results came in weaker than expected, missing consensus on both revenue and earnings per share. And notice what this means in practice. It is not merely that Iron earned less. It is that the plans of buyers and sellers formed before the report were revealed to be miscoordinated. Now we follow the trail into the specific figures because numbers are not decorations. Second quarter revenue declined to $184.7 million, below expectations, and down from $240.3 million in the first quarter. The company also reported a net loss of $155.4